Welcome back to Sip&Talk. I'm Joe.
And I'm Sunny. Good morning, good afternoon, good evening, wherever you are in the world.
Welcome. And my coffee today is extra robust. It needs to be, because we are diving into a forecast from the market legend himself, Larry Williams.
The creator of the Williams-Persar indicator.
Exactly. His predictions usually hit with the force of like 3 espresso shots. And sitting opposite me is the cool, collected analyst currently surrounded by a mountain of charts and data.
Just trying to keep up with the cycles, frankly.
Well, we just wrapped up 2025, and everyone is focused on 2026. Larry Williams just dropped his Forecast 2026 report, and I have to ask, did he really just throw out what feels like a nuclear-level forecast this time?
He absolutely did. He didn't mince words at all. Larry explicitly called for a historic buy point in 2026.
Wow. Okay, so not just another dip.
No, he framed it as an extraordinary, maybe even a generational market opportunity.
Okay, we have to unpack this. A generational low point. What's the foundation for that? I mean, where is he getting this kind of conviction?
It all comes down to something he calls cyclical convergence. His whole system relies on the intersection of 3 extremely powerful, historically verifiable market cycles.
They're all pointing to 2026.
All pointing to the same window in 2026. We're looking at the 3-year cycle, the decennial cycle, which tracks years ending in a 6 time, and finally, the presidential election cycle.
The midterm year effect.
Specifically, the midterm year effect.
Okay, it is a very precise collection of data points.
Mm-hmm.
So, our mission today for you, our dedicated Sip&Talkers, is to give you a complete guide. How should you prepare for 2026 when these 3 massive forces collide?
Mm-hmm.
And maybe more importantly, how do you confirm that low?
Grab your coffee?
Yeah.
Let's start with the cyclical logic that really sets the stage for all this.
Right. This is where it gets really interesting. Larry Williams built his entire reputation on understanding these market rhythms. Let's deconstruct why his math is pointing directly at 2026.
Okay, so we begin with the most fundamental one. The 3-year cycle logic. Larry observed that the Dow Jones Industrial Average, the TJIA, it doesn't move randomly. It has a significant cyclical low approximately every 3.14 years.
Wait, 3.14? That's almost exactly pi. Is that just a weird coincidence?
It's more statistical than metaphysical, but yeah, it has a very high correlation historically. If you trace the market back, the last significant cyclical low we saw was in October 2023.
Okay.
So you move forward 3.14 years from there, and where do you land?
Late 2026.
Exactly. That's the first long-term pillar that establishes the general time frame.
All right, that gives us the long view. What about this decennial pattern? Why are years ending in a 6 foot so special?
Historically, years ending in 6, so think 2016, 2006, 1996, they often experience a pretty significant market correction. It feels like a midterm exam for the market.
A midterm exam. I like that.
Yeah, it's a period of necessary consolidation where, excesses get wrung out. This correction usually hits hard in the 2nd or 3rd quarter, but critically, it's almost always followed by a very powerful multi-quarter rally.
So the 6 foot year provides the dip before the rip, basically. And the final leg of this tripod is the political one, the midterm election effect.
Correct. 2026 is an American midterm election year, and honestly, this might be the most compelling pattern of the 3.
Really? Why is that?
Well, data from long-term historical analysts like the Stock Traders Almanac consistently shows that the lowest point in the entire 4-year presidential cycle tends to land smack in the midterm year.
Usually around late Q3, Q4, right?
That's right. It's when political uncertainty peaks, everyone expects gridlock, and that fear creates the best buying opportunity.
So if I'm understanding this right, the convergence of the 3.14-year cycle, the 6-year correction, and the midterm dip, it all guarantees a massive slap, a big downfall, followed by a gold brick.
That's the hope. But we really have to clarify the mindset here. You likened it to a startup burning cash before profit, which I'd kind of push back on.
Fair enough. Burning cash usually ends pretty badly.
Exactly. And the distinction here is crucial for your psychology as an investor. The market could rally because the Fed is cutting rates due to a gentle recession, which feels, manageable.
Right.
Or, and this is what Larry seems convinced is going to happen, the buy point is generated by terrifying, vicious, inflation-induced panic selling. And that requires real courage to act on.
Ah, okay, I see. Panic driven by inflation means the central bank's hands are tied. They might have to keep rates high even as stocks are falling. That makes a dip feel much, much scarier.
Precisely. And that's why Larry used the word extraordinary to describe this low. He mentioned it might be the clearest, most compelling signal he has seen in his entire professional career.
Wow.
So if we accept that historical premise, the deeper the market is driven by that inflation-fueled fear, the bigger the generational opportunity is for people who can keep their discipline.
That historical weight is significant. I've got my nerves of steel ready. Now let's get tactical. If Larry is promising a low, we need to know when and how to confirm it. He didn't give a specific date, did he?
No, specific dates are impossible, but he gave a very clear time frame based on how these cycles overlap. The decennial 6-foot-year consolidation historically runs from May into September.
Okay.
Then you layer the midterm bottom on top of that, which traditionally aligns with the infamous October effect. So the clearest chart signal in his analysis points firmly to the end of Q3 or the start of Q4 2026.
So we know the likely time frame for the correction.
Mm-hmm.
But knowing when the crash is likely is only half the battle.
Well,
How do we avoid, catching a falling knife? We need the actionable triggers. What's in Larry's confirmation toolkit?
we need two primary confirmations. The first one uses his namesake, the Williams-Purcell indicator.
The classic momentum oscillator.
Right. So if the market starts its decline, the first thing you need to watch for is the Persic-Purcell to fall below the 80 line. That just confirms the market is oversold.
Okay, so it's in the red zone.
Yeah.
But what's the actual buy signal?
The key actionable signal is to look for bottom divergence.
Tell us more about the divergence. What does that mean?
This is where the psychology comes in. Divergence means the price chart and the indicator chart are telling you two different stories. The price will make a terrifying new low, scaring everyone out of the market.
Right. Panic selling.
But the Purcell indicator fails to make a new low. It makes a higher low. And this matters because it means that even though the headlines are awful and the price is lower, the actual velocity of the selling pressure is running out of steam. The tank of sellers is empty.
That's brilliant. So you're watching the market's heart rate, not just its screaming face. What's the second tool? The big money tool.
The second tool gives us a peek at what the professionals are doing. It's the COT report, the Commitment of Traders report. Specifically, we focus on the commercial traders.
And why are they the smart money?
Because they aren't speculators, they're hedgers. They're the actual producers, processors, corporations dealing in the assets being traded. They accumulate massive positions to hedge long-term business risk, not to make a quick buck.
So we track what the giants are doing while retail investors are hitting the panic button.
Exactly. During peak market pessimism in mid-2026, you need to watch for the COT index to spike dramatically, ideally above 80. This signals that those commercial institutions are quietly and secretly catching the falling knife. They're accumulating long positions because they see deep value where everyone else just sees fear.
This gives us a fantastic structured roadmap. Let's quickly summarize the observation checklist for our listeners.
Okay, start preparing today. Q1 2026. You're accumulating cash, dry powder is essential, and you're monitoring inflation data, CPI, PCE,
Q2.
Q2 2026. Watch for the initial correction. Check the Purcell for oversold conditions below Nordic 80.
Q3 is a big one.
Q3 is the critical scanning period. You're looking for that COT index to spike above 80, and most importantly, that Purcell bottom divergence.
And then Q4 is go time.
If you see the confirmations, Q4 is for your phased entry. And you watch for a confirmed breakthrough of the 18-day moving average, which signals the reversal is underway.
That feels manageable, as long as we can handle the emotional roller coaster.
Right.
So let's talk about the downside now. We have to provide some balance here. What are the macro risks that could just derail this whole traditional cycle?
Let's start with the good news, the structural bullish case. Analysis from places like Bloomberg suggests that as the midterms approach, fiscal policies usually become more supportive. Politicians hate a bad economy before an election.
Sure. And structurally, I mean, the enormous investment we've seen in AI infrastructure, that has to start paying off by 2026, right?
That's the key fundamental support. By 2026, those multi-billion-dollar AI investments should move from just being an expense to generating actual verifiable revenue. That provides a strong economic backbone for a recovery.
Okay, now for the cold shower. Larry Williams himself raised the biggest red flag. He explicitly warned that he is convinced inflation will return in 2026. How big of a threat is that to his own prediction?
It's the highest risk. It's the elephant in the room. If inflation accelerates, the Federal Reserve might be forced to keep interest rates high deep into 2026.
And that would shatter the whole pattern.
It would completely shatter the expectation of an economic easing that normally follows a midterm correction. It could make the low deeper and last much longer than expected.
Wait, so if the Fed is stuck battling inflation, is it possible the cyclical pattern just breaks down completely? Are we putting too much faith in history when the macro picture is so unique?
That is exactly the right question to ask. Cycles are models. They're not laws of physics. And if the inflation is genuinely sticky and aggressive, the midterm cycle, which relies on a return to normal, will be compromised. On top of that, you have publications like the Financial Times highlighting trade policy instability and tariffs, which could cause the volatility index to just spike.
So the VIX goes crazy, and suddenly the buy point feels less like a discount and more like stepping into quicksand.
Precisely. Extreme volatility can wash out even the most disciplined investors if their position sizing is wrong. And Larry had another long-term warning about debt. He's deeply concerned about government deficits, suggesting that even if a powerful low hits in 2026, the market might enter a multi-year sideways era afterward.
A sideways era where the market is just volatile but essentially flat for years? That sounds like a nightmare for patient investors.
It means you could see massive paper gains only to watch them disappear over and over again. You have to manage that predicted volatility in early 2026 to ensure you aren't washed out before the true opportunity arrives.
That brings us perfectly to our final section, investor takeaways. We hear predictions of a total collapse every year. We need to talk about the perma-bears, the experts who are always predicting doom.
Right, and that phenomenon is powerful because fear sells so much better than optimism. These experts rely on what we call the broken clock effect.
A broken clock is right twice a day.
Exactly. Market cycles ensure that someone who is always predicting a crash will eventually be right, and they get all this credibility, even though they missed 99 previous rallies.
Right, so we have to filter out that noise. Regardless of how deep the 2026 dip is, how do we practically handle the volatility?
Discipline. It's all about discipline. You have to revisit your investment principles during the panic. History shows markets always recover. I mean, the U.S. stock market's long-term average return is still robust, between 7 and 10%. So the practical application is risk management.
How does this specific forecast influence our risk management strategy today?
Well, since we have a high conviction forecast for a major low, the strategy isn't just to diversify, but to aggressively increase your cash holdings now. This dry powder may be held in short-term bond ETFs, has to be specifically earmarked for that Q3, Q4 window. You need to decide today. If the market drops 30%, will you sell or will you execute the buy order you planned in the call?
That shift from defensive holding to active preparation is so key, which leads to the big question for the learner out there. How should those of us who primarily use index funds adjust for this? Should we just abandon dollar-cost averaging?
That's a great question. For the vast majority of retail investors, index funds are still the foundation. Low cost, great long-term average return. But Larry's prediction presents an interesting choice for those with cash on the sidelines.
What's that choice?
DCA is fantastic because it removes timing risk. But if you have high conviction and you have that cash you've been building up, you could consider a hybrid approach. Keep your regular DCA going, but save a strategic portion, say 20 to 30% of your annual investment, for a lump sum entry when and only when the PERSAR and COT signals confirm that 2026 low.
That makes a lot of sense. So you leverage the historical cycle without betting the whole farm on perfect timing. But it requires the discipline not to spend that cash reserve until Q3.
Absolutely. The best investor is often the one who makes the fewest emotional decisions. Index funds are your safety net, but that strategic deployment of cash in 2026 is the alpha generator this prediction offers.
The 2026 signal is rare, driven by powerful cyclical convergence. But the risk factors, especially inflation, mean you need precision, using the PERSAR divergence and COT signals and absolute nerves of steel. Preparation is key. Panic is fatal.
I couldn't have summarized it better. And a reminder to everyone, we're objective guides exploring data. This is not financial advice. It's an exploration of historical probability. You have to conduct your own independent research.
So, since AI infrastructure is a key theme here, let's leave you with a provocative thought. Beyond the obvious chip makers and server companies, what unexpected sector might be positioned for the biggest gain during that Q3, Q4 consolidation? Maybe the companies that optimize the power grid or the cooling technology needed to run these massive heat-generating AI data centers. Something for you to mull over as you build your 2026 watch list.
That raises a fascinating question about those second-order effects. A great place for further exploration.
Well, thank you for helping us unpack this enormous forecast and for sharing your insights. We hope this objective discussion helps you in your independent thinking.
Stay disciplined, Sip&Talkers.
Be sure to subscribe to the Sip and Talk podcast so you never miss another deep exploration into market cycles and trends. And don't forget to check out our old friend Mickey's YouTube channel, Mickey to Life, for fun memes and the latest travel vlogs. We'll catch you next time.